Hello, everyone. Thanks for coming our IBFD webinar today. I am Susan Lee. I'm a Senior Research Associate here in IBFD. Today, we'll be talking about U.S. tax reform. Probably you already know it brings us a significant and dramatic changes when it comes to the tax planning and tax structure and all kind of tax consequences we have. Those complexity, changes, and challenges, it might be not only for the U.S. companies doing business in the United States, but also all entities doing business in outside of the world, such as Europe and Asia. So today's through the topics, we try to explore what kind of practical implication we can have and how we can reduce such a tax risk from these tax reforms. So here we have two tax experts from the United States. I have Jeff and Mike here today. Hello.
Hello.
Thanks for coming here.
So I'm Mike Leibovitz. I'm with PwC in the United States. I'm a managing director, and I'm part of our National Integrated Global Structuring practice.
And I'm Jeff Kornblatt. I'm an international tax partner at Reed Smith, which is a global law firm and specialize in international taxation matters.
Thank you. So today's agenda is as follows. Today we will be talking about some higher level about the U.S. tax reform, just to give you a bit of some broader picture on this. And then we'll be going to more specific issue such as IP structures. It involves some GILTI and FDII issues. And then we were talking about in the interest expense reputations and the BIT challenges and how this U.S. tax reform impact on the merger and acquisitions and holding company structures as well, and how we could do in after repatriating their cashes after this repatriation tax, which is called the toll charges. So I'll be moving on to this Mike here, and he will go over this higher level of this tax reform. Mike?
Great. Thanks, Sujan. So before we jump into some of the specific comments on the U.S. tax reform, we thought it'd be helpful just to give a quick overview of some of the key provisions that impact international operations. First and foremost, we have the reduction of our U.S. corporate rate, our headline rate, from 35% down to 21%. That's a major, significant change and was designed to be a very visible movement of the U.S. rate down to more international norms. Coupled with that, we have our new incentive for foreign-derived intangible income, sometimes referred to as FDII, FDII, FODI, depending on which person you're talking to. But that's an incentive designed to reward multinationals that are exploiting international or intangible property offshore. Similarly, we now have a new incentive for U.S. taxpayers to invest in the United States, in that we're giving them 100% deduction, immediate deduction for investments in qualified tangible property. So rather than forcing taxpayers to depreciate investments in tangible property, we're giving them, at least for the next 5 years, an incentive and whereby we give them 100% deduction on an immediate deduction on investments in tangible property. On the other hand, we currently give a current deduction, an immediate deduction for R&D. That's changing in 2022. After that, we'll only allow R&D to be amortized over 5 years. Similarly, we're also changing our rules for net operating losses. We'll only be allowing an 80% deduction for net operating losses for NOLs that derive or arise after 2018. Consistent with international norms, we've tightened up our interest expense limitations. We're now an EBITDA and soon to be an EBIT-based interest expense limitation. We now have a new base erosion anti-abuse tax known as the BEAT, and this operates as a minimum tax to recalculate taxable income to remove the deductions for certain expenses paid to foreign-related parties, and we'll spend some time talking about that. And finally, and perhaps most significantly for U.S. multinationals that have significant IP-related income, we have our new GILTI regime, Global Intangible Low-Taxed Income. And this is a new regime that's designed to immediately tax the offshore earnings of U.S. multinationals that are driven by low tax profits. So all of these provisions impact, all of these drive investment decisions, both for U.S. multinationals and for inbound companies investing in the United States. They impact financing, they impact M&A, and you'll see on the slide here sort of a number of high-level observations, and we're going to touch on these individually. But all of the key provisions that I spoke about a second ago impact investment, and what that means is that the U.S. The U.S. is now a more significant competitor to European countries, Asian countries, in terms of where U.S. multinationals make their critical investment decisions, their critical M&A decisions, and how they finance their operations. Let's move on to some of the sort of specific discussions.
Yes, so Jeff going to give us more specific tax issue, how this U.S. tax reform is going to impact on these intellectual property structures. Jeff?
Thanks, Sujin. One of the most important areas where these new changes are going to come into effect are in the context of international intangible property planning. I think it's no secret that for the last 30 years, placement of intangible property and the income associated with it has been a key planning element of international taxation. And historically, there were a lot of structures, we have some listed here, that essentially resulted in low taxed or homeless income. Prior to U.S. tax reform, we already had through the BEPS action plans and the European anti-tax avoidance directives and local country actions, various things were putting pressure on this, whether it was expansion of controlled foreign corporation rules, new transfer pricing rules, refusal to provide treaty benefits or reduce withholding taxes, and to hybrid structures or to other things that were deemed to be inappropriate, and a new focus on awarding benefits only where there was significant development and exploitation and other activities, the DEMPI functions that we've listed here. If we could go to the next slide. So already there was a movement, I think, amongst a lot of multinationals to get their intellectual property out of deficient structures and into real jurisdictions where they could try to actually wed substantive activities, the DEMPI activities, with their intellectual property and still achieve a relatively low rate. We've listed some of them here. The U.S. now has to be brought into this conversation because the U.S., through both tightening up its own transfer pricing rules more in line with BEPS, making it harder to move intellectual property out of the United States, and at the same time introducing its FDII regime, which for a U.S. multinational operating in the United States, not through a branch, not through a foreign corporation, but in the United States through its employees, can provide a really significantly lower tax rate, which 13.125% tax rate on income that's derived from foreign sources. That, coupled with that's the carrot. The stick is our GILTI regime, which imposes a minimum tax on foreign earnings that are not otherwise caught up in our anti-deferral regime. There's some carve-outs for small amounts of income and allocable to tangible property, but almost everything else gets soaked up by this GILTI tax. These two regimes make it more attractive to put intellectual property in the United States and more inhospitable to move it out of the United States or keep it out of the United States. I'll go on to these next. We put together a model here. I don't want to go through it in detail, but as you can see modeled, what we have tried to put out here is an example where we have alternatively a structure where somebody has placed their intellectual property in Ireland, where somebody has placed it in a tax haven, and where somebody has placed it in the United States. And you can see that the effective tax rates, look at the very bottom, have now really started to converge, making the U.S. a much more hospitable jurisdiction.
And I think one of the observations on this slide is you'll see that because of the application of GILTI, even if we were able to get our foreign rate down significantly below, say, the Irish rate of 12.5% through R&D deductions, stepped up basis in a local country, even if we were able to get our effective tax rate, we're able to cut it in half. The combination or the effect of GILTI will essentially be to tax that income currently in the United States. So even if we reduce our rate down to, say, 6%, our overall rate after GILTI moves it back up closer to 12%. And so you have a real interesting decision to make here as to where you put your IP, because putting it in the U.S., as Jeff said, gets you 13 1/8. That for many multinationals will be the easiest structure to implement. And so the question is it worth maintaining an international IP structure if you're only getting an additional, say, 2% or a 1.5% benefit?
And right, implement and defend. Annually, you're going to have to consider, well, what's this going to look like? Is this structure okay? I've made a big effort to set it up offshore. Now I've got to defend it against a lot of interested parties, and am I really getting a lot of benefit out of that? As we move into this last bit, I want to go through very quickly. We've got some different considerations, however, as we bring this into place. We've already talked about where can you really wed substance to an effective tax rate that's desirable. What are the limitations on an operating model that would do so? Many of the transitional planning approaches out there are going to be dependent upon moving intellectual property from a defective structure into one that's sustainable, but also getting a step up in the amortizable basis of the intellectual property. Will you actually achieve that? And then the final things to consider here are, we have a US rate now of 21%. We have the FDII regime, which leverages off that. That regime is expected to be challenged in the WTO. Our European partners are not comfortable that it conforms to BEPS. And at the same time, the US corporate rate may very well go up if there is a change of control in Congress.
And I guess one final point is, for a U.S. multinational or even a foreign multinational doing business in the U.S., moving IP into the United States is a very significant decision, because once IP comes to the United States, given some of our, some other changes that were made as part of U.S. tax reform, once IP comes to the United States, it's not going out again, because the U.S. tax cost to move IP out of the United States, even at a 21% rate, is much more costly going forward, just because of some of the changes to the code that have been made with respect to intellectual property. So once it's coming here, or once it's coming to the United States, it's not leaving. And so a U.S. multinational has to be very confident in the 21% rate and the viability, the long-term sustainability of the FDII regime.
Okay, so here we're talking about this IP tax issue. So let's moving on to the one poll question here. In order for you, I'm sorry, for you to get some CPE credit, please answer these questions. So question one, actually here is more like some personal questions. So please be aware that all the answers are confidential. So the question here is that in light of the BEPS and the US tax reforms, are you considering relocating your IP? So answer A here is yes, we are moving into the dumpy compliant jurisdictions. Option B, or we are moving into the United States. And option C is we are waiting until the effective dates of the Oecd provisions come. Or option D is no, we already have a BEPS compliant structure. So I will give you a 30-second here, and please answer. Okay, seems like we got all the answer for now, and I will just stop right here. It seems like the answer C, we are waiting until the effective dates of the Oecd provisions come. So do you have any comments on this, Mike?
Yeah,
you got the more answer on C.
Yeah, that isn't surprising. Again, IP is the sort of the most most significant asset of most companies, and the Oecd directives were represented some significant wholesale changes in the approach to intellectual property, and there were many structures out there that Jeff alluded to that will take some work to unwind and make compliant with BEPS and the Oecds. And so you could see the logic of a multinational waiting until they see how countries implement the ATADs and waiting until the last possible moment to unwind their structures.
Mike, I think that's right, and some of the risks we talked about, the U.S. Provisions, I think also come to play. So I think people are aware that they've got to change. People have a good sense of why they have to change, but they're not quite certain as to where they will go, and so they want to see further solidification. Well, what's going to be available in some of the European jurisdictions, and will the U.S. benefits be sustainable?
I see. Thank you, Jeff. The next we can talking about more issue on the interest expense. U.S. tax reform put it on a lot of limitation on this, and we're pretty sure there's a huge impact on this structure issue.
Thank you. So I'm going to go through this, and in the interest of time, we're going to sort of make this point rather brief, which is that we have now adopted a 30% of EBITDA, and as Mike pointed out earlier, this will drop down to 30% of EBIT, limitation on interest expense. It replaces the former regime that many people who are watching may have formerly encountered, and it's going to have a broad application. It's going to apply to related party, third party. We believe it'll apply to controlled foreign corporations of U.S. companies, and it'll apply in prior to and in conjunction with BEAT. And overall, it's going to have a. I'm going to move on to the next slide. It's going to have a significant impact in light of the proliferation of similar deductions elsewhere on how multinationals structure their borrowing. And so you can see it's cash pooling structures, foreign currency and hedging strategies, basic decisions about where and how much is going to be borrowed by a multinational. All of this has to be taken into account, both in the U.S. and outside of the U.S. U.S. rules now being one component in what has to be addressed.
And I think that the thing that's interesting is certainly multinationals that have heavy investments in tangible property will be very concerned, beginning in 2022 when the limitation changes from an EBITDA-based, a pre-depreciation and amortization limitation, to an EBIT-based limitation after including depreciation and amortization. That's the statute as it currently exists, or currently enacted. There is some expectation that as we get closer to 2021, 2022, that there will be some significant political pressure to try to retain the EBITDA-based limitation. You'll have many taxpayers that have significant investments in tangible property pressuring Congress to retain the EBITDA-based limitation rather than go to the EBIT-based limitation. And so similar to the 21% rate, FDII, there will be, even though we've just enacted tax reform, you can expect that the U.S. tax regime will, still be in flux for a few years to come.
And Mike, I have a concern that when I agree that pressure will be there, and the U.S. has a long history of advancing or extending taxpayer-friendly benefits by a one-year period, and then another one-year period, and then another one-year period. It's wonderful to have the benefits. It's difficult if you're trying to plan and only looking at effectively a one-year extension, not sure what will happen the following year. So I'm concerned it might end up taking that kind of a route.
Absolutely.
Okay, here we have some questions coming from our viewers, and they say, has the U.S. subscribed to the OECD BEPS, and especially the TP action points? Do they follow or adopt them? Do you have any?
The transfer pricing action points?
Mm-hmm. Go ahead.
Okay, so the United States, just prior to the final BEPS reports, issued regulations that, the quick answer, the United States says no, it does not need to adopt the OECD BEPS actions 8 through 10 because its rules already reflected that. However, immediately prior to the issuance of the final BEPS reports, the U.S. put out new regulations that suspiciously looked a whole lot like the verbiage that you saw in Action Item 8, and that has now been put into the model transfer pricing rules. Those rules were standing out there, and then important aspects of them, ones on which our Internal Revenue Service had lost in court cases leading up to tax reform, were now effectively brought in by statute. So modifications to our transfer pricing rules on the one hand, our classification of what constitutes intangible property on the other hand, now by statute have been brought in. The regulations are still far more expansive than the statutory changes, what I would say is that as a practical effect, the U.S. is going to be taking a position that's consistent with BEPS in many circumstances. The one place I think the U.S. is more cautious is the circumstances under which they will come in, restructure, and entirely recharacterize a transaction. I think that the language that is under the transfer pricing, the model transfer pricing rules now and from action item 8 is broader than the U.S. Treasury embraces.
And I think the only other one thing that's worth mentioning is, and we're not spending any time on it, but one of the other aspects of U.S. tax reform is we enacted a couple of anti-hybrid provisions that are directly consistent with BEPS Action 2. So there are a few anti-hybrid provisions that make the U.S. consistent with both BEPS and sort of the direction that the ATADs are going.
Thank you both. So let's moving on to the next topic. Is a huge and very important topic to discuss is BEAT, we call the base erosion and anti-abuse tax. Mike will go over on this issue. Mike?
Yes, a very sort of unfortunately named provision. This is the outcome of all the debate around what was originally called a border adjustment tax. But essentially the BEAT is a minimum tax. It's a 10% minimum tax, 5% this year, 12.5% beginning after 2025. But essentially it's a minimum tax. If you're familiar with the corporate alternative minimum tax, it's very similar to that in that it recalculates a taxpayer's income, taking out or removing deductions for certain expenses, what we'll refer to as beatable or base erosion payments. And so if you're an applicable taxpayer, then BEAT will apply to you and apply this 10% minimum tax. So what is an applicable taxpayer? The main provision here, it's directed towards large multinationals. So it's a company that's got average annual gross receipts of at least 500 million US dollars for the last 3 tax periods. And so if you're at that threshold, then BEAT will apply to you. And BEAT will apply if your base erosion percentages are at least a material amount. So if your base erosion payments are at least 3% of your overall payments, then the BEAT tax will apply.
Mike, I wanted to stop in. I mean, are these applied on an aggregated basis when we're looking at the calculation?
Yeah, we'll touch on that.
Perfect.
And so the next slide, you can go through these at your leisure, but basically what they're designed to, the structure of BEAT is designed to basically remove the deduction for base erosion payments and recalculate taxable income using a 10% rate. And so this is sort of the flow chart. We're not going to sort of go through it in detail, but this is the flow chart that is designed to convert taxable income to your base erosion minimum taxable amount. So let's go to the next slide. So BEAT applies to base erosion payments. And so what is a base erosion payment? Essentially, it's any amount paid or accrued by the taxpayer to a foreign related party, and for which you're getting a current deduction. So for example, if you're paying interest to a foreign related party, or if you're paying royalties to a foreign related party, you're making service management fees or service fee payments to a foreign related party, all those are beatable payments, or payments that are subject to the BEAT, the base erosion anti-abuse tax. Some very important exceptions currently. The most important one is cost of goods sold. So if you're buying inventory from a foreign related party, that payment is not a base erosion payment. So you can buy inventory from a foreign related party. So if you think about a foreign multinational selling product into the United States, the payment that represents inventory is not a beatable payment. And then separately, if you're making a payment that happens to be subject to our full 30% U.S. withholding tax, that is not a beatable payment as well. So next slide. So as Jeff alluded to, the $500 million test is an aggregate test. And the aggregation is not just on a consolidated return basis. You aggregate your entire affiliated group to determine whether you meet the $500 million gross receipts test. There are some exceptions for foreign members, non-U.S. members of the affiliated group, but there is a broad aggregation test to determine whether you meet the $500 million threshold.
Mike, is the base erosion percentage also applied on that aggregation?
Yes. Okay. Another important issue is what is considered cost of goods sold, what is considered to be inventory. And we have, a long history. There's a lot of precedent in the U.S. on what constitutes inventory. When are expenses capitalized as part of inventory, and when are they sort of separately stated? As a result of BEAT, there will be, taxpayers will be very motivated to optimize and maximize the payments, the characterization of payments that get characterized as cost of goods sold and get capitalized into inventory. There's an important exception for payments to related parties for services, for related party services, for which we're using the service cost method under the U.S. transfer pricing rules. This is in our regulation 482-9. So the way the statute is drafted is expenses that are eligible for the service cost method are not subject to BEAT. And essentially that means that expenses that are eligible for that method are services that do not have a markup associated with them. But oftentimes, because of transfer pricing rules, both in the U.S. and outside the U.S., services do require some sort of a markup. And so there's an open question on it. Even if you have, back office administrative services that are eligible for the method, is it the entire amount of the payment, including the markup, that is subject to BEAT, or only the markup itself that is subject to BEAT? And so that's an open question. A number of companies net payments going back and forth through the international group. That's very important because BEAT is applied to the gross payment amount. So even if you're making a net payment, the way our withholding rules work and the way our general tax rules work is, even though you're netting payments, BEAT will apply to the gross amount of the payment, even if you're netting that payment against a receivable that you have from the related party.
That could be very painful and unexpected.
Absolutely. BEAT has some very significant operating model considerations. So if you think about a U.S., a multinational that's making payments to a foreign related party that have third-party expenses embedded in that payment, BEAT will encourage a multinational to start unbundling the expenses and look at how they're paying related and unrelated parties in order to mitigate the impact of BEAT. And finally, as Jeff alluded to in the interest expense discussion, BEAT applies before the interest expense limitation. So there's some interesting coordination rules between BEAT and the interest expense limitation that will, frankly, drive a number of taxpayers crazy in terms of how the rules interact. It's not, BEAT itself is a complex regime. When you couple that with interest expense, our hybrid limitations, and our pre-existing limitations for interest expense, our debt versus equity rules, means that taxpayers, before they can deduct an expense, will have to go through a number of hurdles to figure out how these rules interact.
I see. Thank you, Mike. Before we moving on to the next slides, they have two questions from our viewers.
Okay.
The first question is that, does the application of a BEAT depends on the substance at the recipient level?
It's a good question. Like many U.S. rules, the characterization of BEAT and what's included as a beatable or a base erosion payment is going to be driven by U.S. characterization. So even though something may be called something different in a foreign jurisdiction, it's the U.S. characterization of that will drive BEAT. And so that, of course, is going to create some potential for double tax. It's going to create some interesting situations where you're not getting a deduction in the U.S. because of BEAT, but you're still picking up the income in the foreign jurisdiction. So, many other provisions, it's U.S. characterization that will drive this.
I was going to say that as an addendum to that, the question was whether you need to be substantive. There needs to be a substantive foreign recipient. I mean, even with a substantive foreign recipient, BEAT will per se apply to that transaction. I think you have nowhere to go but down from there. If the payment itself, if the transaction was recast or ignored under U.S. tax principles, or there was an adjustment under transfer pricing, I think that would precede the application, U.S. transfer pricing, that would precede the application of BEAT. But once it's cleared those hurdles, BEAT's going to come into play.
Thank you, Jeff. And then on a second question here is that in the previous slides, we're talking about some various percentage that in the BEATs in facing, such as a 10% minimum tax, but the next year in the beginning will be 5%, and then afterwards it's going to 12.5%. So the viewers is saying that is some kind of confusion, the percentage-wise, and
sure.
Why it can be.
So the minimum just to clarify, so the BEAT the BEAT rate, the minimum tax rate is 10%. That's the sort of the base rate. Only in 2018, just to facilitate the transition into BEAT, the rate is 5%. And then, like a number of provisions in 2025, the tax rate goes up to 12.5%. And all of these variations in rates, similar to some of the other provisions we discussed at the outset of the presentation, the only reason for those changes is to make sure that the entire U.S. tax reform package did not cost more than the set amount that Congress was prepared to spend on tax reform. And so that's one of the reasons why the rates change. There's nothing special other than the rate is just changing. But what, of course, that does mean is that that's an opportunity for Congress yet to act again, in 3 years, 5 years, whatever, to change the rate again.
Thank you, Mike. And we have another poll question here. I just say again, this is completely confidential, so feel free to answer our question here. So how are we preparing for the introduction to the BEAT? The answer A could be yes, we are under the 500 million threshold. Option B is we are reviewing all of our outbound payment from the U.S. to address the impact of a BEAT. And we do not make material related party payments from the United States. Option D is we are reviewing our supply chain in order to reduce the amount of outbound payment. So I will give you 30 seconds here. Please answer our questions. Okay. Okay, so seems like we got all the answer here now. Seems like the answer A, yes, we are trying to keep under the 500 million threshold here. Jeff and Mike, are you surprised on these results, or?
Oh, I think there's all kinds of taxpayers out there, and by design, this was supposed to hit particularly large taxpayers, and so I think it's something that for obviously many will have little relevance, but for many multinationals, this is going to become important.
I see. That's also common to based on your practice experience.
Yeah, and it's interesting. Companies want to grow, and so a company that's under the $500 million threshold probably has aspirations to grow above the $500 million threshold, and one of the downsides of becoming successful is you'll be successfully growing into BEAT.
I see. Okay, thank you, Mike. And let's moving on to the next two topics. It's about how to we do about the releasing cash after this all the reform you have. So Mike, what's the priority if we have all this offshore cash, and then after this all the tax implication? What would be those most important things they should be considering?
So as a result of the repatriation tax, the toll charge, U.S. multinationals no longer have a tax need to keep cash offshore. And so estimates of the amount of cash that has been released as a result of U.S. tax reform is anywhere between $2 and $4 trillion. And so U.S. multinationals have to decide what are they going to do with that cash. And the main priorities, as we've surveyed and worked with clients around the world with respect to their plans for this, and there's a lot of there's a lot of sort of public information in terms of what companies are doing with their offshore cash. But the number one priority is M&A. They're going to use their offshore cash to make additional mergers and acquisitions. Second is share repurchases. Third, they're going to repay debt. Fourth, they're going to make capital investment either in the U.S. or elsewhere, taking advantage of our new 100% deduction for investments in U.S. property. They're going to pay dividends, and they might also give some money back to their employees in terms of salaries and bonuses. But these are the number one priority. These are the priorities. But the number one priority, far and away, is M&A, mergers and acquisitions. So we thought it would be important to spend a little bit of time on the impact of M&A and what tax reform what impact tax reform is having with respect to both buyers and sellers. So what tax reform does, first and foremost, is it allows a U.S. multinational to access previously unremitted foreign cash for acquisitions, and then includes acquisitions of U.S. targets. Prior to tax reform, a U.S. multinational was incentivized to acquire, making a decision between acquiring a U.S. target or a non-U.S. target. A U.S. multinational was more incentivized from a tax standpoint to acquire a foreign multinational, just because it was easier from a tax standpoint to integrate intellectual property, to get to align the target structure with the buyer's structure. That has changed as a result of tax reform. In addition, because buyers can now immediately expense a target's tangible assets in the United States, that changes how a buyer might look at a target. Similarly, if a buyer was looking at a target because there were tax attributes, they might get a step up in basis, they might get net operating losses. The reduction of the U.S. rate down to 21% reduces the benefit of those attributes. And then separately, as Jeff alluded to, our changes in interest expense, because we now have a 30% EBITDA interest expense limitation, that's going to impact how multinationals finance their acquisitions. If you're a seller, this is great news for sellers, because now a buyer, there's less of a double tax on sellers when you want to do an asset sale, and buyers generally want asset sales. A seller is less disincentivized or less disadvantaged in doing an asset sale as a result of the changes in the corporate rate. And so what that means as a result of that, if we go to the next slide, it removes some of the barriers for U.S. buyers of foreign assets. It allows much more flexibility for U.S. buyers to buy in the U.S., buy overseas, restructure, move target IP into the structure, and so the other related benefit is, prior to tax reform, private equity buyers had a significant advantage over strategic buyers, over a corporate buyer. Because a corporate buyer, when they're making an acquisition, they need to integrate, they need to align the purchaser and target structures. A private equity buyer isn't necessarily worried about that. The private equity buyer is making the acquisition, is going to hold it for a period of time, and then sell it. There isn't that integration step, there isn't that cost to integrate that a U.S. strategic buyer has. All of the U.S. tax reform changes ameliorate to a certain extent the advantage that private equity buyers had over strategics. And so the combination of that, along with the $2 to $4 trillion release of foreign cash essentially will make valuations, will cause valuations to increase, making every deal more expensive. And so if you're a seller, U.S. tax reform is good news all the way around. It's good news for buyers, but if you're a seller, this is great news. There's a lot more cash in the market, and you have a lot more dollars chasing the same deals, and you have a lot more competitors in the market, both from a private equity and a strategic standpoint.
And you're likely going to pay less tax on the sale.
And you're going to pay less tax, exactly.
You see, it's a very interesting, but also quite important to consider as a future perspective.
Absolutely.
There will be one quick question from our viewers saying that, well, we now know we will having some kind of toll charge for the cash offshore. And then we ask that how actually this repatriation tax actually works. Could you just give us some more some higher level how this toll charge works?
Sure. So essentially it's a one-time tax on the unremitted earnings of a U.S. multinational. It's extremely complex. And the tax rate depends on the amount of your earnings that are represented by cash, or the amount of your earnings that were not represented by cash. But essentially, it's a one-time tax on the unremitted earnings of an applicable U.S. multinational. And so that was effective at the end. I mean, it's for companies that are calendar year companies, that was effective at the end of 2017. And so U.S. multinationals that were calendar year companies, they've dealt with this. They can pay the tax over 8 years, but that was a one-time tax that was designed to pay for all of the other provisions that we've talked about, the FDII provision, the conversion, the movement of the U.S. to a participation exemption regime. But it's essentially a one-time tax on the unremitted earnings. For fiscal year companies, they're still dealing with it. They're still dealing with this, but in a sense, in general, it's just a one-time tax, either at 8% or 15%, depending on the amount of your earnings that are represented by cash or non-cash.
And I wanted to clarify, though, although in this particular course we're going to be focusing on U.S. corporate-headed multinationals, it would also apply to foreign corporations, specified corporations, which we typically would think of as companies that were subject to our controlled foreign corporation regime. That might be held by non-corporate, whether it was a fund, whether it was some other partnership, whether it was even individuals. They would also have been subject to this tax. For them, the consequences of the tax and the burden of the tax was greater than it was for corporate holders, and most of them, because they're on the calendar year, have already suffered through this.
Thank you both. And so next, let's moving on to our next poll questions. We discuss about this merger and acquisition implication. So, if you were to consider this M&A transaction in the future, or if you are in the process of it, so how will your tax reform affect your M&A strategy? So, option A will be we now have access previously unlimited offshore cash. We have more flexibility in the types of targets we consider. Option C is we expect more competitions and higher valuation for our potential targets. And option D will be all of the above. So I will give you some time, and then please answer the following. Okay. Okay. Yes, it seems like we got all the answers come. Interestingly, we got the answer equally. Answer A and answer B are most answered. So, Mike, do you think it's A and D? D is a David, yes. So yeah. All of the above, and we now have access to previously unlimited offshore cash.
Yeah, this was meant to be an easy poll question. As we mentioned, we expect all of these to be relevant. This has really unlocked the access that a U.S. multinational had to its offshore earnings. substantial more flexibility in targets. I mean, the real answer here is D, all of the above.
Mm-hmm. So thank you, Mike. Okay, so let's moving on to the next topics about holding company structure. So Jeff, this will be a huge impact because of the tax reform. Could you tell us more about this?
Sure. So once again, I think we're seeing a convergence of international changes and U.S. changes. Many U.S. multinationals historically had a holding company or even a series of holding companies, and that was to facilitate a number of things, not the least of which was minimizing the impact of our controlled foreign corporate rules and also allowing for untaxed offshore earnings to be utilized within the foreign subsidiaries without triggering a negative U.S. tax impact. With respect to really both of those in many facets now, the U.S. rules are going to allow even a group that doesn't have a holding company, it has foreign corporations that are separated, might be held just by a U.S. parent or a variety of U.S. entities, the cash could come home and be redeployed without additional U.S. tax. This coming into play with changes like the multilateral instrument and other concerns internationally are going to put a focus on whether or not withholding taxes are still, whether or not a holding company is still useful. We move on to the next slide. One area where the use of a holding company, at least for a U.S. multinational, will continue to have real import will be in situations where that holding company can access and facilitate the movement of earnings with the minimization of foreign withholding taxes. Those are really no longer going to be creditable to the U.S. Multinational in the way that they were before. And so every bit of foreign withholding taxes paid as an incremental cost. Trying to access a structure that will minimize that through either a superior treaty network, common economic organizations such as the EU or what have you, is going to be very attractive. But as we can see, there's going to have to be substance now in this holding company because of international changes. We've listed two top choices, the UK and Netherlands. Mike, do you want to give some thoughts on what makes each of them attractive?
Well, what makes both of them attractive is these are countries where it's most likely that a multinational is going to have substance, whether it's a foreign multinational or a U.S. multinational. These are the places where multinationals have substance. And so I think this is particularly relevant in light of the MLI, because the MLI is forcing your holding company to have substance. And so if you had a holding company that there was no real substance there, and we won't talk about specific jurisdiction, but if you think about a holding company that was just maintained by a corporate service company, had maybe a local director, but no real substance, the MLI is going to operate to eliminate the benefit of treaties for that holding company. And so where are you most likely to have substance with respect to a holding company? It's where you already have substance in the region anyway, and that with respect to a holding company regime, that's the UK and the Netherlands as the top two choices. I think one other comment that's worth making here is the MLI, when it's finally implemented, will impact hundreds and hundreds of treaties. But as many of you are aware, the U.S. is not and won't be a signatory to the MLI. And the reason for that is the U.S. already believes that U.S. treaty policy implements the provisions of the MLI, and the U.S. Prefers to negotiate treaties on a country-by-country basis rather than wholesale amending all of the treaties at once. And so the U.S. treaty policy is to enact treaty policy on a treaty-by-treaty basis. And so that the MLI is inconsistent with that. And so you might say, well, then the MLI is not relevant to a U.S. multinational, but it's very relevant to a U.S. multinational, because if the U.S. multinational is using a holding company in the U.K., Netherlands, Luxembourg, Switzerland, how that U.S. multinational is taxed on sales, below the holding company level is relevant. So the MLI is relevant if the U.S. The U.S. multinational uses a holding company. So a good example here would be a U.S. multinational that has, say, a Luxembourg holding company with minimal substance, and that Luxembourg holding company holds a Spanish, French, Italian subsidiary that, absent a treaty, would tax the local sale of that, say, Spanish subsidiary. So under the Lux Spanish treaty, there's no Spanish tax on a sale by Luxembourg of the Spanish subsidiary. If there's no substance in the Luxembourg holding company, Spain can post MLI, Spain can tax that. And so that's relevant to a U.S. multinational as well if it holds, Spain through Luxembourg. So even though the U.S. is not a signatory to the MLI is relevant to U.S. multinationals as well.
And I just wanted to make one last comment. I think Mike has actually covered it through his illustration, which was very good. The strategy here, of course, is this: that if you had a naked structure where a bunch of foreign entities are held by the U.S. Vertically, there may be withholding taxes, payback on distributions or other transactions, but we're focusing on distributions, or alternatively on a sale. The hope and goal is, when you use a UK and Netherlands, that distributions to the holding company or capital gains realized by the holding company are going to be minimized or eliminated under the broader treaty networks that the UK and the Netherlands have. And then in turn, distributions coming back will not be subject to withholding tax because of, for example, in the UK, local law doesn't impose a withholding tax. That's the goal, as Mike is just explaining, I think, some very good detail. To make that work, you need to be in a substantive jurisdictions, which is why the UKs and the Netherlands of the world are going to be leading the way, and some other jurisdictions where it's very hard to put material substance in place are going to fall behind.
See, thank you both. So the final topic is talking about what to do with the cash after paying this toll charge at the foreign country. But when they bring this cash back to United States, it's tax-free. But then there might be some conditions and consideration we have to think about. Mike?
Yep. So, as we mentioned, there's $2 to $4 trillion of offshore cash eligible to be brought back to the United States without additional tax. And all future earnings, because of the enactment of our participation exemption regime, they can be brought back to the U.S. without additional U.S. tax. The challenge is that doesn't necessarily mean that you can just willy-nilly bring those earnings back to the United States. And so even though there's no U.S. tax, we thought it was important to remember that there are still some significant local country issues that need to be addressed. So, for example, many countries require you to have adequate distributable reserves before you you pay a dividend out of the local country back to the United States. And so you might have earnings from a U.S. standpoint. And the CFO of the U.S. multinational, he's heard about U.S. tax reform. He now knows he or she knows he can get access to all of that foreign cash. Tells the tax director, bring it all back, bring the cash back. Well, wait a minute, we don't have distributable reserves in this country. We don't have distributable reserves in that country. We can't bring it back from a local law standpoint. And so navigating all of the local country limitations on distributable reserves is significant. Similarly, as Jeff mentioned, withholding taxes. There's no U.S. tax costs now to bring dividends back to the United States. If there is withholding tax on that dividend, then that's a real cash tax cost, and so that's a significant significant issue that needs to be addressed. And needs to be managed, and so that touches back on Jeff's point earlier on, potentially using holding companies to mitigate withholding taxes. The toll charge, as we mentioned earlier, is based on the U.S. calculation of earnings. That doesn't necessarily coincide, and invariably it won't coincide with cash and what's the true amount of cash that an entity has in a particular country. And so there will often be a disconnect between how much earnings, the amount of earnings that are eligible to be repatriated, and the amount of cash in the local country. And then finally, even though you're eligible to bring back all of the cash, all of the earnings, and you've already been taxed on those earnings as a result of the toll charge or the repatriation tax, the local country, you still may have cash needs in that local country. And so a U.S. multinational will now be balancing its cash needs both in the U.S. and overseas. And so there is, some interesting coordination that's required between the various mechanisms that you use to repatriate earnings. It's not just a dividend. You can do a capital, in some countries you do a capital reduction. In some countries you do a, liquidation or something. The mechanisms vary, and those mechanisms coordination will be required between the U.S. and foreign jurisdictions to determine what the optimum mechanism is for repatriation.
And I wanted to just put a comment in there too, that we're going to have this. Three of the four items listed there were, well, actually all of them were to a greater or lesser extent considerations prior to U.S. tax reform. The withholding taxes, I think, have taken on a much greater importance because there's nothing to credit them against now. But these issues had been in place. The difference was because of the lockout effect, the infrequency of repatriations of actual earnings and cash back to the U.S. Didn't have to encounter it as often. Now, both because companies coming into 2018 largely have huge stockpiles of cash that they can bring home, the 2 to 4 trillion that Mike has referenced, plus the annual impact of our GILTI rule and other rules that are going to impose tax and sort of allow every year an annual layer that can be brought home and maybe needs to be brought home to at least pay the tax. It's going to put a lot of pressure on resolving these issues because annually it could be coming up.
And because of that lockout effect, historically, U.S. multinationals would operate because they couldn't bring their foreign earnings back. They couldn't bring their foreign cash back. They were more heavily leveraged. On average, they were more heavily leveraged in the U.S. than they were outside the U.S. And since many countries in Europe and elsewhere were quicker to enact interest expense limitation rules, that enabled U.S. multinationals to be more leveraged in the U.S. And so now, after tax reform, because we can bring all this cash back, there will be, as we said earlier, there will be real motivation to bring as much cash back as possible to pay down debt in the U.S. And so you'll have CFOs, treasurers, etc., leaning on the tax directors of multinationals to get access to that cash as quickly and as easily as possible. And as we've discussed, it's not as easy as just pushing a button and moving all the cash back to the United States.
Well, and this dovetails with our earlier point, which is that it's going to introduce, or this will be occurring at the same time that multinationals consider how they have their capital structured and where they have their borrowing occurring.
Absolutely.
These are very insightful comments, and thank you so much for that. Considering all this cash issue, how to bring back to home, and we have another poll question related to it. And the next question will be, what is your top priority for the use of those offshore cash? So option A is merger and acquisition, option B is debt repayment, and option C is a capital investment, option D as a dividend. So I will give you a few seconds and then please answer the followings. Okay. Oh, so we got all the answers now. Okay. So it seems like all the majority of the answers is option D as a dividends. Mike and Jeff, do you think this is a very obvious result? We got the more preference to going to the dividends?
I'm not surprised by it, but I think it does depend on the company. I think also we got an indication earlier on that these companies are probably less than the 500 million threshold. I think companies that might have a different profile probably are going to tend more towards something that's going to fall through A, B, or C, whether that's addressing the repayment of debt because they need to, or because they've got they want to be acquisitive at this time.
And again, you've had the lockout effect for so many years that there is a need to use cash to pay dividends. And it's interesting because we are starting to see now that U.S. multinationals have now reported, certainly U.S. public companies have now reported their repatriation tax. You now have analysts in analyst calls asking, what are we doing with the cash? How are we going to, how are you getting the cash back, and what are you doing for your shareholders? And paying a dividend is sort of an immediate benefit to a shareholder. So it's not surprising as well.
I see. Thank you. So before we moving to the final questions, I wanted to give you some opportunity to give us some of your general comments on this U.S. tax reform, and then how from the foreign subsidiaries in Europe or outside the world, and how they should be aware of it. Could you have some final comments on us?
I mean, my comments here would probably be even a more global element of that, which is that I think that if we go back to 2012, the initiation of the BEPS, I think there was this dream, certainly on the U.S. side, that everything was going to come into perfect coordination and rules would stop the placement of income into stateless income buckets, and everybody would be fine. And I think that what we have seen instead is a proliferation of a lot of rules, a lot of very complex rules, and a lot of lack of coordination and frankly, tax competition. I think the U.S. has shown that it's throwing its hat into the ring on the tax competition here. The UK is another, and Australia, two other jurisdictions which clearly have pursued at least some elements of tax regimes which are different from what we see in BEPS. We have BEPS proliferating in Europe, but the two Oecds go beyond BEPS. We've got state aid initiated investigations and big news, I guess, today on relating to Apple. And what I think this leads to is for taxpayers, they are confronted by a world where the old structures and the old strategies are clearly no longer in place, but they have a lot of work to do because there's a lot of rules to understand, there's a lot of competition, and there is a lot of opportunities for, frankly, I think, double taxation. And there's a lot of uncertainty because some of these rules it's not clear that they will be sustained.
I see.
And I think that's probably the operative word is uncertainty. As Jeff said, these rules, tax reform, this is the first time we have made significant changes to the tax code since 1986. And in 1986, when tax reform was going through Congress, it was a slow, deliberate, bipartisan process. And even though there were wholesale changes, people generally understood or were able to plan into and see the direction that the code was going. This tax reform was enacted very quickly, and there is a lot of uncertainty. There's a lot of, to be polite, drafting inconsistencies. There are things that still need to be thought through, either through regulation, technical corrections to the tax code. And so there is a lot of uncertainty, but at the same time, U.S. or multinationals have to make some very critical decisions as a result of tax reform. And so the challenge is, how do you make all of those critical decisions in an environment of uncertainty and an environment of complexity, and that not just the U.S., but how everything is changing around the world, as Jeff said, with respect to BEPS. And so the world was already changing as a result of BEPS, but now it's significantly changed as a result of U.S. tax reform, and it's certainly a challenging time. everything has changed. There's, prior to tax reform, there's no way in the world we would have recommended, or the general recommendation would be for a U.S. multinational to bring all of its IP back to the United States. But there are significant major multinationals considering doing just that as a result of tax reform, and that's a significant sort of sea change in the direction of international tax. So it's a period of uncertainty, it's a period of challenge and complexity, and if you're in tax, it makes your job fun.
May you live in interesting times, right?
Exactly.
Exactly.
Absolutely.
Thank you so much for that. So we have some more generic questions from our viewers. The question would be, would you be more happy if the original border tax adjustment has been accepted by the Congress?
I don't think I would have. I think there was a lot of that was going to be quite controversial, and I think BEAT is still controversial in itself. But I don't think that I would say I would have been happier had border adjustment been adopted.
Yeah, and BEAT applies both to the border adjustment tax was something that was directed towards inbound investors into the United States. While BEAT, the focus of BEAT is inbound, it applies to both inbounds and outbounds. And in fact, from our experience to date, I've dealt with as many inbound or outbound issues as it relates to BEAT as inbound. And so I look at BEAT more as a minimum tax. It's similar to the corporate alternative minimum tax, and it doesn't have the same sort of protectionist aspect that the border adjustment tax had. I'd like to think that even with the border adjustment tax, as it went through Congress, it would have gotten to this direction in any event. There were a lot of political reasons why you called it a border adjustment tax, but tax ideas that start in the political realm, once they work through Congress, they tend more often than not to become at least somewhat more policy based. And despite all of the flaws in how tax reform came together, there is still some policy underlying BEAT and the other sort of major provisions of tax reform. And so yeah, I like BEAT better than BAT.
Yeah, that's a good answer. And another question coming from here is that considering the U.S. side, they restrict their tax base so that they make a tax revenue to be uncertain. On the other hand, in Europe, they also have some tough measure on it towards the U.S. multinational, just like in Apple cases and Amazon cases here. So the question here is that how important the EU state aid for the U.S. multinationals, and how do they can minimize those risks? And actually, we try to address those topics in our follow-up webinars in October, also with Mike. So just to give us a brief view on this two dynamics view. In one hand, in the U.S. sides, and have a tough in tax reform. On the other hand, in Europe, we have a harsh on the tax measure on that.
Well, Mike, do you want to take the first stab of this?
Yeah, I mean, state aid is interesting, certainly for a U.S. taxpayer, because a U.S. multinational is generally used to negotiating and dealing with a country, and with the, when the and deal with the country, or dealing with the sort of the tax divisions of the EU. We were used to dealing with the EU directives, and very familiar with that. And I think as the EU Competition Directorate sort of stepped into tax, it took a lot of U.S. multinationals by surprise. But essentially, what it's forced is an investigation into the viability and the sustainability of rulings that you'll have with a particular country, and so I mean it's relevant it's definitely relevant to a U.S. multinational, but I think it's even more relevant to a country like Ireland, who is trying to encourage, has historically tried to encourage investment. Ireland, all of the countries, the Netherlands, Italy, etc., have tried to encourage investment consistent with normal traditional tax norms. I think the uncertainty that there is this sort of non-tax body that stepping into tax sort of makes everything a bit more uncertain. And so it's, for lack of a better way to phrase this, it's just one more thing that a U.S. multinational or even a non-U.S. multinational needs to deal with. And the interesting thing will be to see how state aid issues develop in a post-BEPS world as countries start to force a marriage between structure and substance. Having your IP in a place where there is substance, whether that is enough to enable the competition directorate to say, yes, okay, the tax authorities in the European region now get it, and so we can back off. I don't really know where that's going to go, but it is one more thing that multinationals need to deal with. I think as the BEPS process plays itself out and tax authorities implement BEPS and the ATADs, in my own personal view, certainly not speaking for PwC here, but in my own personal view, that should be reason enough for the competition directorate to step back and allow tax policy to be made by tax authorities rather than the competition directorate.
I think I have a slightly different response to that, although largely in line with what Mike has said. I think that if the question is asking, well, what's the U.S. sort of policy position towards state aid, I think it's quite evident that our Congress, our Treasury, really feel that this is an attack on U.S. multinationals. Now, obviously, some non-U.S. multinationals have also been the targets of state aid, but I think the big ticket items so far have been U.S. Even right before Apple came out, I think there was a significant white paper put out by our Treasury. No, actually not by Treasury, I think by Joint Committee on Taxation, but to argue why this shouldn't be utilized. But the reality is these are being applied to date against structures that have come into existence or had occurred and operated under sort of pre-BEPS law. And there's a real concern there because Mike said there was a sense that, well, nothing illegal was done. There was a reliance upon rulings, which was common and had been done for many years. And if you really look at these problems, let's go back to the Irish example, it wasn't just an Irish issue. Where were all the countries that were making source payments to Ireland? Where were their transfer pricing authorities? If they thought there wasn't substance in Ireland or beyond that, why hadn't they taken care of that issue? And since nobody had acted, what really was the wrong being committed by the taxpayer? I think, as Mike also indicated, this is all going to be quite self-policing going forward. Structures that are the sort that have been under scrutiny in these state aid, they really won't be possible as ATAD and other BEPS actions go into place. There will be transfer pricing adjustments. Presumably, there's going to be a huge requirement that there be substance in the first place. So those kind of structures won't be there. I think, and the reliance upon rulings will change as well, because one, the rulings will in many cases be published. Another, we're going to have information statements, country by country reporting and worldwide reporting that's going to show those pockets of low taxed income. So a lot of that will fall away. I think the question that I would be wondering is, will there be a state aid investigation generation 2 that doesn't look at these structures but maybe goes back and decides that a regime that was put into place, or a tax rate even that was put into place, or something else that seems fine today, seems BEPS compliant today, that in 5 years there's going to be a conclusion, well, it actually wasn't BEPS compliant. I would hope that's not where it's going to go, but I think in light of the unexpected application of state aid in the first instance, it's probably a concern that lingers in the back of the heads of some CFOs.
And I think another aspect of that is that many of the state aid cases, particularly Apple, Amazon, Starbucks, Fiat, they're all they're largely transfer pricing based cases, and one of the concerns I've always had with respect to this is that when I sort of read the state aid rulings and the background to the state aid cases, at their core they go back to transfer price, and they go back to OECD, long-standing OECD transfer pricing guidelines. And that's the general underlying basis that these rulings were driven by. And so the other sort of body that I think is relevant to the whole state aid discussion is not just U.S. multinationals. It's not just the local EU tax authorities. It would be the OECD, because then here is another body, a non-tax body, coming in and evaluating rulings based on long-held transfer pricing methodology. And so I do think that there's a role to be played by the OECD in helping frame the post-BEPS world, particularly as it relates to state aid. I think the OECD has a role to play in defending its transfer pricing guidance in a post-BEPS environment.
Thank you for the great comments on this. So hopefully we got all the good overview about the U.S. tax reform. And the final question we have in the poll question is more like your resource questions. So here we have to ask about how has U.S. tax reform impact your local budgets and resources for your tax compliance and plannings? So answer A, we already had ample resources to deal with the U.S. tax reform. Answer B is we are still evaluating what additional resources we needed. And answer C, we are educating management on the additional resources required. Answer D is we are adding new resources and expanding budget as a result of U.S. tax reform. Please answer the following. Okay, I just wait a few more seconds to get the more answers to come. Okay, so it seems like the answer B, we are still evaluating what additional resources we needed. So it seems like they are still evaluating the resources, considering that U.S. tax reform for them is still a lot of uncertainty. So I think that's kind of a reasonable answer for now. So I think that's all for now we have. So here we have more webinars to coming up. The next webinar will be talking about more specific European tax, particularly in those key attention countries such as Ireland, Luxembourg, and Netherlands and Switzerland. So please stay tuned on that. And please don't forget to download our slides of today's webinar to click the link below. And then, so thank you so much for that. So hopefully through the webinar today, you got all the insightful knowledge from those two experts from the United States. And hopefully this webinar will be very helpful for your future tax planning practice. So thank you, Jeff, and thank you, Mike.
Thank you.
Thank you.